Guys, good morning, good day, good afternoon, good evening, whichever part of the world, whichever part of the country you are watching me from. You are welcome to today's episode. My name is Sunday, and I welcome you all to Having Forex. This is where you get the best teachings, the best information as to, learning forex trading from the scratch to where the level you start making profits and you know gradually approaching to a level where you became a professional in the field. Like I told us, this is a skill that is very, very profitable, and it's worthwhile. It's something that you can do, but you must be able to, study hard and have interest. Today's topic is what we call market structure. Market structure, because in the forex market, there's a way market is being structured. So one we need to learn about it. In the previous videos, I've taught us candlestick patterns because it's the language that is being spoken in the forex market. When you open your chart, all you'll be seeing is candlesticks, and all the candlestick, each candlestick represents an activity, a story of what is going on, or the past event, or even the current one. Today I'm going to be teaching us what we call a market structure. And what is market structure? Market structure is simply the study of market behavior. The study of market behavior, how the forex market behaves, the activities that is ongoing. The study of what? The market behavior. And one of the important skills you need to learn and master is how to read and understand the structure and the condition of a forex market. It's very, very important, guys. Once you open a chart, you should be able to know what is going on presently. You should know what the kind of market that is playing at that particular time that you open your chart. So it's very, very important. Another one is a critical market structure is a critical skill that will enable you to use the price action strategies in the right market condition. Being able to interpret and know the structure and the condition of a forex market at every given time is very, very critical, because once you know the structure of a forex market and the condition, you should be able to apply your strategies in the right way and in the right market, because we have market types and each market type has its own strategy that works. So we should be very, very mindful, on the strategies that we apply depending on the market condition. After you have mastered the skill, you will be able to answer these questions anytime you open your chart. Once you open your chart, we should be able to answer some certain questions. What is going on right now? Who is leading? And, is it that the market is bearish or bullish and all that? So, questions you'll be able to answer are these. Once you have acquired the skill of a condition and the structure of forex market, you will know what the crowds are doing. And who are the crowds? The buyers, the sellers, the investors, the retailers, the big boys who are financial bodies, even the government, financial institutions. You'll be able to know what they are doing at that point once you open your chart. And you will be able to answer this question: who is in control of the current market? Who is in control? You will know once you open your chart and master the market structure. You will be able to know who is in control of the market at that particular time. And you'll be able to know when to buy currencies in the market, because if you're a forex trader, it's either you are buying currency or you are selling currency. Or even if you are trading stocks, it's either you are buying stocks or you are selling stocks. And everything is being represented in currency. And what you will be seeing in your chart, market chart, is the candlesticks. That is why candlestick patterns very, very interesting and very, 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 very important for us to know. Because once you open your chart, what you'll be seeing is candlesticks, and you see patterns. So if you don't understand the patterns, you cannot trade. And if you just try to dash into the market without getting the understanding, it's a very big problem and it's not advisable. And you'll be able to know when to buy currencies in the market, when to sell currencies in the market. At the point where you need to sell, you should know when to sell. And you'll be able to know when to take your profit. Because once you understand the market structure and you have done your analysis, you place a trade, you should know exact point where you should take your profit. Let me just chip in something. For you to take a profit, after you have done your analysis, place your trade, where you put your profit target, it's usually where we call a resistant level. For example, if you are going long, it should be a resistant level. A resistant level is a place where the price action gets to and it turns back, where it will get to and it will turn back. For example, this place is a resistance level, this place. So you see, the price was going up, it gets to this place, there was a rejection, it came down. It went up again, there was a rejection, it came down. From here, this is what we call consolidation. It went up again, there was a rejection. At the end of the day, there was a rejection and it now turns, it started coming downward. So this place is known as a resistance level where it's advisable to always place your target, where you can take your profit, because if you don't take your profit here, let's say for example you place an entry here, it will rarely go up like this. As soon as it's approaching here, you take your profit. Otherwise, if there's a change of character, price will start coming down. It might come down and hit your stop loss. So once you have equipped yourself with being able to interpret market structure, you should know when to take your profit, when to sell currencies in the market, when to buy currencies in the market. You will know who is in control of the current market. You will know what the crowds are doing, the investors, the retailers, the government, the banks, financial institutions. And again, you will know when to exit the market, the actual place where you know that you need to exit the market. And another one is you will know when to stay away from the market, because it's not all the market that is worth trading. Because we have types of market. We have the ranging market, we have the trending market, then we have the choppy market. So if a market is choppy, it's not just going, it's just bouncing up and down. Read buyers and sellers, no one is in control. They are just bouncing the thing, just like you bouncing a ball. To go up and come down, go up and come down. So that is the type of, that is a market, what we call choppy market. Once it's like that, it is advisable to stay away. At that point, you don't trade. You wait for the market, either the sellers to take charge of the market, to take control, or the buyer to take control of the market. So if the buyers take control of the market, you see a bullish trend. If the sellers take control of the market, you see a bearish trend. So we have types of market structure. Like I told us, we have type of market structure. Through your price action analysis, you will experience three types of market structure. We have the trending market, which I've already hinted us. We have the ranging market. Then we have the choppy market. Now, for example, if you see this kind of trend, you will know that, you will just know that this is a bearish trend from up left to the downside. This place now, this is what we call pullback, then it continues again. It did a pullback to retest this low, then it continues down. So we have trending market, we have ranging market, and we have the choppy market. And trending market is of two types. Now we have the types of trending market. We have the uptrend, known as the bullish trend. We have the downtrend, known as the bearish trend. Now, trending markets are simply characterized by a repeating patterns. Trending markets they have characters that are always repeated. Just like uptrend, which is one of them, is the character of uptrend, for you to know that the current trend is an uptrend. You have the higher highs and higher lows. What do you mean by higher highs and higher lows? Now, this is an uptrend, for example. This is a high, pull back to the support level, another high, pull back to the support level, another high, pull back to the support level, this is another highs. Now, here is what we call impulsive move, retracement. Impulsive move, retracement, impulsive move, another retracement, impulsive move. If I ask you now, where will this retracement get to? I'm telling you, you should know by now, because this is an impulsive move. It will retrace to this level. Okay, then this is an impulsive move. This is a retracement, right? Impulsive move, this is a retracement. Impulsive move, this retracement is supposed to get to like 50%. That is why we have what we call Fibonacci retracement. You can use this to measure it, for you to know the actual point it will get to before it will go before it will do another impulsive move. So like this, we say a market is bullish, is in a bullish trend, is in a bullish trend. Okay, this is a resistance, this is a support, this is a resistance, this is support, this is resistance, and this is support. So that is the characteristics of an uptrend. Higher highs and higher lows. We have this low is lower than this low. This low, this one is higher than this low. This one is higher than this low. This one is higher than this low. This high is low. This high is higher than this. This high is higher than this. This high is higher than this. The next high should be higher than this. If it fails at this point, if it produces a support, a retracement to this place, and it fails to go to produce another high, that means you need to watch out. There's about change of character is about to happen. But before it to be valid, you must see a candlestick pattern in between that will indicate that a change of trend is about to happen. So it's very, very important. So downtrend, the characteristics of downtrend, we have a lower highs and a lower lows. This is it. This is downtrend. Remember I told us that an uptrend starts from the left downside to the up right side. Then a downtrend starts from the up top side to the lower right side. It's like this. So the uptrend, the downtrend now is, this is an impulsive move. This is retracement. Impulsive move, retracement, impulsive move, retracement, impulsive move. Then a retracement from here will come up to the 50% level. To this level, it will get to this level and it will make another impulsive move. But if it fails to make another impulsive move, be aware, be on guard. A change of character is about to happen. That means a reversal of trend is about to play. So before it to be valid, before you know that there is a change of character, there has to be a candlestick pattern that will be printed right here that will signify a reversal pattern. It could be a bullish engulfing or a morning star candlestick pattern. And it could just be a hammer. That is a bullish hammer that will show a rejection, a pin bar. So we have so many. I've just taught us few, but as we progress, I will still give you more. But the most important ones that are very common is what I've just given to us. Okay, so it's like that. This is an uptrend. This is a down trend. Okay, all these are very, very important for us to understand, because once you open your chart, you should be able to identify the current trend. It could be an uptrend, it could be a downtrend, it could be a choppy market, it could be a rangy market. So you must be able to understand. Like if you want to trade, I will go into details in the next video, but let me just hint on, if you want to trade an uptrend, what you need to do is, there's an impulse here. This is a retracement. This is impulsive move, a retracement, impulsive move, a retracement, impulsive move, a retracement. Now, for example, you just open your chart and you discover that this candle has just printed and it's at this level and it's an uptrend. You have identified that it's an uptrend. All you need to do is be patient, wait for it to make a pullback to this level. As soon as it gets to this level, you enter the trade. Because once you enter the trade, it's going up. Enter the trade, the previous support level, put your stop loss maybe 2 pips below or 5 pips below, depending on your risk management. We'll get to risk management. I will surely, dissect everything. So as you make a pullback to this point, you can see this is a support level. This is a support level. This is a support level. Now, this one, let's say, for example, is like this. A price action gets to this place, this resistance level. This is a pullback to this point, support level. As soon as it gets to this place, before it starts making another impulsive move, you place your trade. You know that this price is going up. So you place your trade, put your stop loss below this place, and just leave it to run. Your target, if you so desire, your target will be here, the next resistance level, before it starts another impulsive move, before it starts another retracement. You have already taken your profit. Now you wait for it to retrace again before it starts another impulsive move. You make your entry, then you just flow with the trend. But if you have gotten to a level, because if you have gotten to a level where you are very confident and you know what you are doing professionally, you know what you are now doing. Now you can place your trade here, make an entry. As it gets here, take your profit and place your entry again to sell to this downside. As soon as it gets here, take your profit, make an entry again, you follow the trend up. That is, you buy. From here, you make an entry, you sell to this point, take your profit. From this point, support level, make an entry, you buy to this point. So you just be following it like that, like that, like that, like that, until you now see a sign that there is change of character that is about to happen. Then you exit, you stay away at that point. Then get a clear picture of what the activities is, the clear picture of the current trend before you now think of maybe you want to go short or you want to stay away. Because after this long move, what will happen is you see what we call consolidation, market consolidation. It's just up, down, and just stick to one parallel line. So at that point, you need to stay away. Wait until the price action breaks below or above that consolidation level before you place any trade, before you decide on what you want to do. That is what it is, guys. In the next video, I hope you've gotten value from this video. All I want you to do, guys, for me is hit the subscribe button, hit the like button, share the video, because it's very, very important that we have, things that we are doing while at home, something that we bring in income to us, added income to our our traditional job that we do. It's very important. Just like you living on your salary is always very, very difficult for you to break through financially. So the only way you can break through financially is for you to have multiple source of income. And this one is very, very vital, is very, very important, is very, very profitable. It does not require it does not require plenty of capital to start. With $50, you have your account open and you will be placing your trade. By so doing, if you are very good in risk management, you are very good in technical analysis, you are very good at what you do, you will start making profit. I tell you guys, this is something that is worth doing. And thank God we have demo account that you can use to always practice before you start placing trade. Before you start, demo account is it's a platform, it's an avenue for you to test your your capability, the level at which you have gotten to, And I will urge us, it's not something you just dash into. You need to study, get the basics. Don't skip any of my video. I'm telling you, these are very, very important, vital informations that you need to, you need to take in and practice all these things that I've taught us. Get a pen and a paper. Anytime you are watching my video, endeavor to take notes so that you refer back to all those notes anytime you are having challenges. On this note, I will call it a day and I will see you guys in the next video. Okay? I love you guys. If you have any comment, drop it at the comment section. If you have any message you want to send to me, use my email, send me mail. I will respond to you. And if you need one-on-one coaching live, that I will sit live one-on-one with you to coach you, and if you feel it is better for me to coach you one-on-one, if that is what you want, for me to coach you one-on-one live with you, for me to pick you, hold your hands, and show you everything that you need to become a forex trader. And even if you can trade stock, you can trade indices, you can trade futures. So for you to learn the basic is very, very key. On this note, I thank you all for everything, for the likes, for the share, for the support. And I want you guys to always share my video. Recommend the video to your friends. You having an Android phone, an iPhone that you just, carry and be going all about. You don't know that that thing is an asset for you. Why not, use it in the correct way, not by just chatting or making calls. You have a phone with an internet. All you need to do is just download an app, a platform app, watch the videos, learn the skill, and you start trading. Thank you guys, and I'll see you guys next time. Bye.